Chapter 7, Debt Securities, Corporate and U.S. Government Loans. In this chapter, understanding the specifics on bonds, examining securities issued by the U.S. government, looking at short-term bonds. Instead of giving up a portion of their company via stock certificates, corporations can borrow money from investors by selling bonds. Local governments, through municipal bonds, and the U.S. government also issue bonds. For Series 7 exam purposes, most bonds are considered safer than stocks. Bondholders aren't holders of a company like shareholders are. They're creditors. Bondholders lend money to an institution for a fixed period of time and receive interest for doing so. This arrangement allows the institution to borrow money on its terms with its chosen maturity date, scheduled interest payments, interest rate, and so on, which it can't do by borrowing from a lending institution. The Series 7 exam tests you on your ability to understand the different types of bonds issued, terminology, and yet some math. This chapter has you covered in topics related to corporate and U.S. government debt securities. You'll also notice that there is a bit of an overlap of the material that you needed to know for the security industry, such as exams and the Series 7 exams. As with other chapters, I've included some questions at the end of the chapter. Tackling bond terms, types, and traits. Before you delve deeper into bonds, make sure you have a good handle on the basics. Understanding the bond basics is a building block that can make all the rest of the bond stuff easier. In this section, I'll first review basic bond terminology and then move on to some bond characteristics. Remembering bond terminology. Series 7 exam designers expect you to know general bond terminology. In this section, I help you reinforce the information you should have already learned from taking the Series Industry Essentials exam. Stuff is basic, but the Series 7 exam does test it. Maturity date. All issued bonds have a stated maturity date, for example, 20 years, 30 years, and so on, which is the date bondholders get paid back for the loans they make. At maturity, bondholders receive par value covered in the next bullet. Investors not looking to tie up their money for a long period of time are more likely to purchase short-term bonds. Par value. Par value is the face value of the bond. Although par value is insignificant to common stockholders where issuers use it solely for bookkeeping purposes, it's important to bondholders. For Series 7 exam purposes, you can assume that the par value for each bond is $1,000 unless otherwise stated in the question. Bond prices are quoted as a percentage of par value, often without the percent sign. A bond trading at 100 is trading at 100% of $1,000 par. Regardless of whether investors purchase a bond for $850 at 85 shares or 100 shares at $1,000 or $1,050 at 105 shares. They'll receive value plus any interest due at the maturity date of the bond, usually with semi-annual interest payments along the way. Corporate bonds are usually quoted in increments of 0.125%. Which equals 0.00125 or $1.25. So a corporate bond quoted at $99.3 frazzle 8 with 99.375% will be trading at $99,900. 93 will be trading at $993.75. Coupon rate. Of course, investors aren't lending money to issuers for nothing. Issuers receive interest for Investors receive interest for providing loans to the issuer. The coupon rate on the bond tells the investor how much annual interest they'll receive. Although bonds are no longer issued with physical coupons, some bonds previously required investors to detach dated coupons, bearer bonds, and partially registered bonds from their bonds and turn them in to receive their interest payments. The coupon rate is expressed as a percentage of par value. For example, a bond with a coupon rate of 6% would pay annual interest of $60. 6% times $1,000 par value. You can assume that bonds pay interest semi-annually unless otherwise stated. So in this example, the investor will receive $30 every 6 months. Remember, bondholders receive interest and payment for the use of the money loan, and stockholders receive dividends. The bond indenture. The indenture, also known as deed of trust or resolution, is a legal agreement between the issuer and its bondholders. It's printed on or attached to the bond certificate. All indentures contain basic terms: the maturity date, the par value, the coupon rate or interest rate, and interest payment dates. All collateral securing the bond, any call or conversation features are all part of the bond indenture. The bond indenture also includes the name of a trustee. A trustee is an organization that administers a bond issued for an institution. It ensures that the bond issuer meets all the terms and conditions associated with the borrowing. Essentially, the trustee tries to make sure that the issuer does the right thing. The following question tests your knowledge of bond interest. Juan Doe purchased 100 of AAA rated bonds issued by SSS Corp. Juan purchased the bonds at 102% of par value, and they are currently trading in the market at 101. If the coupon rate is 3.5%, how much annual interest does Juan receive? A, $17.50. B, $35. C, $1,750. D, $3,500. The correct answer is choice D. This is a nice, easy question after you wade through the information that you don't need. You only need the number of bonds and the coupon rate to figure out the answer. And don't let yourself get distracted by the rate and purchase price or market price. That information is there to confuse you. 1. Purchase 10 bonds with a par value of $1,000. Remember, you can assume $1,000 par with a coupon rate of 3.5%. So do the math. 100 bonds times $1,000 par times 3.5% equals 3,500. Choice C would have been correct if the question had asked for the semi-annual interest. Comparing secured and unsecured bonds. The assets of the issuer or may not back bonds. For test purposes, assume that bonds backed by collateral assets that the issuer owns are considered safer for the investor. Secured bonds or bonds backed by collateral involve a pledge from the issuer that a specific asset, for instance property, will be sold to pay off the outstanding debt in the event of default. Previously, with all else being equal, secured bonds normally have a lower yield than unsecured bonds issued by the same company. In Series 7, test your knowledge of several types of secured bonds. Mortgage bonds. These bonds are backed by the property that the issuer owns. In the event of default or bankruptcy, the issuer must liquidate the property to pay off the outstanding bonds. Mortgage bonds may be open or closed-ended. With an open-end mortgage bond, the issuer may borrow more money using the same property as collateral. With a closed-end mortgage bond, the issuer cannot borrow more money using the same property as collateral. Equipment trust. This type of bond is mainly used by transportation companies and is backed by the equipment they own. For instance, airplanes or trucks. If the company defaults on its bonds, it sells the assets backing the bonds to satisfy the debt. Collateral trust. These bonds are backed by financial assets, stocks, and bonds that the issuer owns. A trustee, a financial institution that the issuer hires, holds the assets and sells them to pay off the bonds in the event of default. Guaranteed bonds. Guaranteed bonds are backed by a firm other than the original issuer, usually a parent company. If the issuer defaults, the parent company pays off the bonds. Unsecured bonds are the opposite of secured bonds. These bonds are not backed by any assets whatsoever, only the good faith and credit of the issuer. If a reputable company that has been around for a long time issues the bonds aren't considered too risky. If they're issued by a relatively new company or one with a bad credit rating, hold on to your seat. Again, for Series 7 exam purposes, assume that unsecured bonds are riskier than secured bonds. Here's the lineup of unsecured bonds. Debentures. These bonds are backed by are backed only by the issuer's good word and written agreement, the indenture, stating that the issuer will pay the investor interest when due, usually semi-annually in par value at maturity. Income adjustment bonds. These bonds are the riskiest of all. The issuer promises to pay par value back at maturity and will make interest payments only if earnings are high enough. Companies in the process of organization usually issue these bonds at a deep discount. For example, the bonds sell for $500 at mature par or $1,000. For test purposes and real-world purposes, you shouldn't recommend these bonds to investors who can't afford to take a lot of risk. Because secured bonds are considered safer than unsecured bonds, secured bonds normally have lower coupon rates. You can assume that for the Series 7, the more risk an investor takes, the more reward they receive. Remember the saying, more risk equals more reward. More reward may be in the form of a higher coupon rate or a lower purchase price. Either one or both lead to a higher yield for the investor. Check out the following question for an example of how the Series 7 may test your knowledge of these types of bonds. John Baryshnikov is a 62-year-old investor who has 50% of his portfolio invested in common stock of up-and-coming companies. The other 50% of his portfolio is invested in a variety of stocks and more secure companies. John would like to start investing in bonds. John is concerned about the safety of his investment. Which of the following bonds would you least likely recommend? Collateral trust bonds, A. B. Mortgage bonds, C. Equipment trust bonds, or D. Income bonds. Answer you're looking for is choice D. This problem includes a lot of garbage information that you don't need to answer the question. One of your jobs, should you decide to accept it, is to dance your way through the question and cherry pick the information that you need. The last sentence is usually the most important one when answering a question. John is looking for safety. Therefore, you least likely recommend income bonds because they're usually issued by companies in the process of reorganizing. As a side note, if you become John's broker, he shouldn't have 100% of his investments in stock. At this age, John should have a decent amount of his portfolio in fixed income securities. From the SIU exam, the secured and unsecured bonds may be in book entry form, most likely full registered, partially registered, or in bearer form. It can also be series bonds, serial bonds, or term bonds. Additional bond types. The following bonds may be secured or unsecured, which would be stated in the bond indenture. Zero coupon bond. Unlike most other bonds, zero coupon bonds do not make interest payments, but instead are issued at a deep discount and mature at par value. The advantage of zero coupon bonds is that they require a relatively low investment, $300, $400, and so on, and they mature at par value, usually $1,000 in a number of years. Since these bonds are issued at discount, the bonds must be accredited. Zero coupon bonds are ideal for planning for future events such as college. Because of the deep discount, the current prices of discount bonds fluctuate quite a bit when interest rates change. Because Euro-dollar bonds and sovereign bonds are issued outside of the U.S., they may be ideal for certain investors looking to protect themselves in the event of a decline in the value of the U.S. dollar. Both are subject to currency risk. Euro-dollar bond. Euro-dollar bonds are dollar-denominated debt securities issued by foreign corporations, foreign governments, international agencies, and U.S. companies with foreign locations, usually Europe. The bonds are issued outside of the U.S. but may trade in the U.S. after 40 days of issuance. Because they are dollar-denominated bonds, the issue and principal payments are in U.S. dollars. Because the securities are issued in a foreign country, they don't have to be registered with the SEC. Remember, since they're issued outside of the U.S., they are subject to currency risk. Sovereign bond. Sovereign bonds are debt securities issued by foreign national governments. In the case of sovereign bonds, the interest and principal payments are paid in the foreign government's currency, not U.S. dollars. As with Euro-dollar bonds, sovereign bonds are subject to currency risk. As you can imagine, sovereign bonds issued by more developed countries are considered safer than those of less developed countries. Also, the riskier the sovereign bonds, the higher the yield. Making basic bond price and yield calculations. The Series 7 exam tests your knowledge of bond prices, bond yields, and how to calculate them. In this section, I review the relationship between bond prices and bond yields. I'll also show you how accrued interest can affect how much customers have to pay for the bond. As you can imagine, outstanding bond prices typically don't remain static. Like other securities, bonds are affected by things like supply and demand, corporate rating change, interest rate changes, whether the bond was purchased at a discount below par value or a premium above par value, and so on. Remember, the relationship between outstanding bond prices and yields is an inverse one. You can assume for Series 7 exam purposes that if interest rates decrease, outstanding bond prices increase and vice versa. Say, for example, that a company issues bonds with a 4% coupon rate for $1,000. After the bonds are on the market, interest rates decrease. The company can now issue bonds with a 3% coupon rate. Investors with the 4% bonds are then in a very good position and can demand the premium for their bonds. Before I show you how the seesaw works, make sure you understand the different yields. Rates down, prices up. Rates up, prices down. Finding bond yields. The following sections review the types of bond yields and how the Series 7 exam tests the topic. Nominal yield, coupon rate. The nominal yield is the easiest yield to understand because it's the coupon rate on the face of the bonds. For Series 7 exam purposes, you can assume that the coupon rate will remain fixed for the life of the bond. If you have a 7% bond, the bond will pay $70 per year interest. Well, that's 7% times $1,000 par value. When the problem states that a security is a 7% or 6% or whatever bond, it's given the nominal yield. Currency yield. The currency yield is the annual rate of return on the security. The currency yield of a bond changes when the market price changes. You can determine the currency yield by dividing the annual interest by the market price. Currency yield equals annual interest divided by market price. The following question involves bond yields. Monique Moneybags purchased one XYZ convertible mortgage bond at 105. 2 years later, the bond is trading at 98. The coupon rate of the bond is 6%. What is the interest yield of the bond? What is the current yield of the bond? A, 5.7%, B, 6%, C, 6.1%, or D, cannot be determined. The correct answer is choice C. Yes, I'm giving you a question with a lot of unnecessary information. All I can tell you is that unfortunately you'll have to get used to it. The Series 7 exam curators are notorious for inserting useless and sometimes misleading information into the questions to daze and confuse you. In this case, you only need the annual interest and market price to calculate the answer. Use the following formula to get your answer. CY equals annual interest divided by market price, which is $60 divided by $980, which equals 6.1%. The annual interest is $60, 6% coupon rate times $1,000 par value. And the current market price is $980, which is 98% of $1,000 par value. The fact that the bond is convertible, bondholders can trade it for common stock, or a mortgage bond backed by the issuer's property, and that it was purchased at 105 or $1,050 is irrelevant. Remember, cannot be determined, as tempting as it may be, is almost never the correct answer on a Series 7 exam. Yield to maturity basis. The yield to maturity, YTM, is a yield an investor can expect if holding the bond until maturity. The YTM takes into account not only the market price but also par value, the coupon rate, and the amount of time until maturity. When someone tells you, hey, what's the bond yielding? He's asking for the YTM. The formula for YTM is as follows. YTM equals annual interest plus annual accretion or annual amortization. all divided by market price plus par value divided by 2. Annual accretion equals par value minus market price, all divided by years until maturity. Annual amortization equals market price minus par value all over years until maturity. This formula can be difficult to remember. If you have it down, kudos to you. It's tested, although somewhat rarely, on the Series 7 exam, and you may be one of the unlucky individuals who needs this formula. Yield to call. The yield to call, YTC, is the amount the investor receives if the bond is called prior to maturity. The calculations are similar to those of YTM, but you substitute the call price for par value. The chances of needing it on a Series 7 exam are even more remote than needing the YTM calculations. Yield to worst. To determine the yield to worst, YTW, you have to calculate the yield to maturity and yield to call for all the call dates, if there is more than one, and choose the lowest. If you get a question on yield to worst, knowing the definition should be enough to get you by. Discount yield. This is the yield on securities that are issued at a discount and don't make interest payments, such as T-bills, T-strips, and zero coupon bonds. To calculate the discount yield, use the following formula. Discount yield equals par minus purchase price divided by par times 360 days divided by numbers of days till maturity. Don't spend too much time working on the discount yield formula, because even though it's in a FINRA outline, I think your chances of having to do calculations using the formula are pretty slim. The most important thing to remember is that T-strips, T-bills, and zero coupon bonds don't make interest payments, and T-bills are issued on a discount yield basis. Using seesaw calculations for pricing yields. In this section, I'll tell you how to use a seesaw to help you better visualize the relationship between bond prices and yields. Higher numbers make the seesaw rise, and the lower numbers make it fall. Calculating accrued interest. When investors purchase outstanding bonds in the market, they may have to pay an additional cost besides the market price and, of course, your commission. The additional cost is called accrued interest. Accrued interest is which is due when bonds are purchased between coupon dates, is a portion of the interest still due to the seller. As you may remember, bonds pay interest once every 6 months. If an investor holds onto a bond for 5 months out of the 6 months period, he is entitled to 5/6 of that next interest payment, and that's accrued interest. When taking the Series 7 exam, you'll need to be able to calculate the number of days of accrued interest that the buyer owes the seller. Although you can calculate the accrued interest with a few different methods, I'm here to make your life easier by telling you one of the simplest ways. Accrued interest on corporate and municipal bonds is calculated on a 360-day year and assumes 30-day months. Accrued interest on U.S. government bonds is calculated using the actual days per year and the actual days per month. The following sample question tests your ability to figure out this prorated amount. Skippy Skippington III purchased a 6% corporate bond on Friday, October 21st. The coupon dates are January 1st and July 1st. How many days of accrued interest does Skippy owe? A, 114. B, 116. C, 119. D, 121. The answer you want is choice A. You have to begin your calculations from the settlement date, the date that the issuer records the new owner's name. Corporate and municipal bonds settle in 2 business days. You're thrown a slight curveball in this question because you had to contend with the weekend. Accrued interest is calculated from the previous coupon date up to, but not including, the settlement date. Now you're probably asking yourself, what the heck does that mean? I can tell you a nice, easy way to calculate this answer. Using the previous example, assume that the settlement date is October 25th. You will write it as 10/25. The previous coupon date would be 7/1 for July 1. You can now set up a subtraction problem. 10/25 minus 7/1, which equals 3/24. That's 3 months times 30-day months plus 24 days is 114 days of accrued interest. First, subtract the 7th month from the 10th month. You end up with 3 months. Because corporate and municipal bonds calculate accrued interest using 30-day months, you have to multiply 3 months by 30 days to get an answer of 90 days. Subtract the previous coupon date 1 from the settlement date 25 to get an answer of 24 days. Add up the 90 days and the 24 days together and you get 114 days as your answer. And listen carefully to try to trip you up. The Series 7 exam writers may include the settlement date in the question. If this is the case, you don't need to add days to the trade date. You can use the same formula to calculate accrued interest on U.S. government securities. However, U.S. government securities settle in one business day, not two. Additionally, U.S. government securities are calculated using actual days per month. The following example shows you how to calculate interest for a U.S. government securities question. Ayla K. purchased a 5% T-bond on Monday, November 18th. The coupon days are January 1st and July 1st. How many days of accrued interest does Ayla owe? A. 135. B. 138. C. 141. Or D. 142. The right answer is choice C. $11.19. The T-bond settled in one business day minus 7/1, the previous coupon date, which equals 4/18, 4 months times 30-day months plus 18 days, which equals 138 days plus 3 days for July, August, and October, which equals 141 days of accrued interest. To get the settlement date, you have to add only one business day. Because the trade date is Monday, November 18th, the settlement date is Tuesday, November 19th. Next, subtract the previous coupon date of July 1st, and you get an answer of 4 months, 18 days. If you multiply the months by 30, as I do in a previous example, and add the days, you end up with 138 days. At this point, you add 1 day for each of the months that have 31 days. July, August, and October. Your answer is 141 days. Your 31-day months are January, March, May, July, August, October, and December. All the rest of the months have 30 days except for February. For February, you subtract 2 days. But if you're that unlucky person that gets a leap year question, subtract only 1 day for February. Most bonds pay interest every 6 months. However, occasionally the dated rate, the first date the bonds start accruing interest of the bonds, don't line up exactly 6 months from the first coupon date. If the first coupon date is more than 6 months from the dated date, it's called a long coupon. And if it's less than 6 months, it's called a short coupon. For newly issued bonds which haven't made an interest payment yet, accrued interest is calculated from the dated date. The first date of bond starts accruing interest, not the previous coupon date, because there isn't one. Determining the best investment, comparing bonds. As you grind your way through Series 7 exam questions, you may be asked to determine the best investment for a particular investor. You need to carefully look at the question for clues to help you choose the correct answer. For instance, is this investor looking for safety? Is the investor looking close to retirement? Consider several factors, including credit rating, callable and put features, and convertible features. Considering bond credit ratings. Institutions that rate bonds are most interested in the likelihood of default, the likelihood that the interest and principal won't be paid when due. For the Series 7 exam, you can assume that the higher the credit rating, the safer the bond, and therefore the lower the yield. Two main bond credit rating companies for corporate and municipal bonds are Moody's and Standard & Poor's. S&P. S&P ratings of BB and lower, and Moody's ratings of BA are lower are considered junk bonds or high yield bonds, which have a high likelihood of default. Another credit rating service called Fitch uses the same rating symbols as Standard & Poor's. Note, different sources may show different variations in how S&P and Moody's ratings compare. However, the relationships here are most common. Listen to this table. Bond credit ratings by quality. Highest, Standard & Poor's, AAA, Moody's, AAA. High, Standard & Poor's, AA, Moody's, AA. Upper medium, A, Moody's, A. Lower medium, BBB, Moody's, BAA. Or buy. Speculative or junk. Standard & Poor's, BB, and Moody's, BA. Speculative junk, interest or principal payments missed. Standard & Poor's, B, Moody's, B. Speculative junk, no interest being paid, C, Moody's, CAA, or CA. And default, Standard & Poor's, D, and Moody's, D. If these categories aren't enough, S&P can break down each category even further by adding either a plus or minus sign after the letter category. The plus sign represents the high end of the category, and the minus sign designates the lower end of the category. If you see no plus or minus sign, the bond is in the middle of the category. Moody's can further break down a category by adding a 1, 2, or 3. The number 1 is the highest rank, 2 represents the middle, and 3 is the lowest. The top 4 ratings are considered investment grade, and the letters below that are considered junk bonds or high yield bonds. The rating company with the capital letters S&P uses all capital letters, AAA, AA, and so on. Additionally, S&P has an ampersand between S and a P in its name. Think of the ampersand as being like a plus sign to help you remember that S&P uses pluses and minuses within its categories. Here's a typical bond ratings question. Place the following Standard & Poor's bond ratings in order from highest to lowest. 1 A plus, 2 AA, 3 A minus, 4 triple B plus. A 1, 2, 3, and 4. B 1, 3, 2, and 4. C 4, 1, 2, and 3. Or D 2, 1, 3, and 4. The correct answer choice is D. When answering this type of question, always look at the letters first. The only time pluses or minus come into play is when the two answers have the same letters, as in statements 1 and 3. The highest choice is AA followed by A plus, because it's higher than A minus, which is even higher than triple B plus. Contrasting callable and put bonds. As you may know, bonds can be issued in callable and put forms. Your mission for the Series 7 exam is to know which is better for investors and when bonds are likely to be called or put. Callable bonds. A callable bond is a bond that the issuer has the right to buy stock from investors at a price stated on the indenture or the deed of interest. Callable bonds are riskier for investors because investors can't control how long they can hold onto bonds. To compensate for the risk, they're usually issued with a higher coupon rate. More risk, more reward. Most callable bonds are issued by call protection. Call protection is the amount of time, usually several years, that an issuer has to wait before calling his bonds. Some callable bonds also have a call premium, which is an amount over par value that an issuer has to pay if calling his bonds in the year or years immediately following the expiration of the call protection. If there's a make whole call provision, it allows the issuer to call bonds provided that the issuer makes a lump sum payment to investors that not only includes payment for the bond but also the present value of any future interest payments investors will miss because of the call. Another type of bond that can be callable is a step coupon bond, also known as step coupon bonds or step-up coupon securities. The step coupon bonds typically start at a low coupon rate, but the coupon rate increases at predetermined intervals, such as every 5 years. The issuer typically has the right to call the bonds at par value at the time the coupon rate is due to increase. Put bonds. Put bonds are better for investors. Put bonds allow the investor to put the bonds back, redeem them to the issuer at any time at the price stated on the indenture. Because the investors have the control, put bonds are of course rarely issued. Because these bonds provide more flexibility to investors who have an interest in the bond and stock prices, put bonds usually have a lower coupon rate. There's a direct correlation between interest rates and when bonds are called or put. Issuers call bonds when interest rates decrease. Investors put bonds when interest rates increase. Listen to the next question and see how this works. Issuers will call their bonds when interest rates A. increase, B. decrease, C. stay the same, and D are fluctuating. The correct answer is choice B. When being adaptable when taking the Series 7 exam can certainly help your cause. In this question, you have to look from the issuer's point of view, not the investor's. An issuer will call bonds when interest rates decrease because they could then redeem the bonds with the higher coupon payments and issue bonds with lower coupon payments to save money. Conversely, investors would put their bonds back to the issuer when interest rates increase so they could invest their money at a higher interest rate. You could assume for Series 7 exam purposes that interest rates increase, bond yields increase. Popping the top on convertible bonds. Bonds that are convertible into common stock are called convertible bonds. Convertible bonds are attractive to investors because investors have an interest in the bond price as well as the price of the underlying stock. The Series 7 exam tests your expertise on whether converting a bond makes sense for the investor. This determination requires you to calculate the parity price of the bond or stock. Parity occurs when convertible bond and underlying stock, the stock is convertible into, are trading equally. That is, when a bond trading for $1,100 is convertible into $1,100 worth of stock. When answering Series 7 exam questions relating to convertible bonds, you always need to get the conversion ratio, the number of shares that the bond is convertible into. Here's a formula for the conversion ratio. Par value divided by conversion price. You can then use the conversion ratio to calculate the parity price. Parity price of the bond equals market price of the stock times conversion ratio. Use a formula to answer the next example question. Jane Q purchased a 6% DIM convertible bond. Her DIM bond is currently trading at 106 and the underlying stock is trading at 26. If the conversion price is 25, which of the following statements are true? 1. The stock is trading above parity. 2. The stock is trading below parity. 3. Converting the bond would be profitable. 3. Converting the bond would not be profitable. A. 1 and 3. B. 1 and 4. C. 2 and 3. D. 2 and 4. The right answer is choice D. You can cross out two answers right away. If the stock is trading above parity, converting is always profitable. And if the stock is trading below parity, converting isn't profitable. Therefore, you can eliminate choices B and C right away. You just increase your odds of getting the question correct from 25 to 50%. To increase your odds from 50 to 100%. Listen to these equations. Conversion ratio. Par value divided by conversion price, which equals $1,000 divided by $25 equals 40 shares. Parity price of the bond is the market price of the stock times conversion ratio. Parity price of the bond equals $26 times 40 shares, which equals $1,040. Currently, the bond is trading for $1,060, 106% of $1,000 par, and is convertible into stock valued at $1,040, the parity price of the bond. Because the value of the bond is greater than the converted value of the stock is trading below parity, and converting wouldn't be profitable. Here's another problem that involves parity price. Alyssa purchased a Spanko Inc. convertible bond at 115 with a conversion ratio of 25. If the common stock for Spanko Inc. is currently $48 per share, when would Alyssa convert her bond? A, right away. B, when the common stock falls below $46 per share. C, when the common stock increases to $50 per share. Or D, never, because the bonds are safer investments than stocks. The answer you want is choice A. Always assume for test purposes that if the stock is trading above parity, the investor should convert. You don't need to figure out if the conversion ratio, because it was already given in the question. Here's how to solve the problem. Parity price of the bond equals a market price of the stock times conversion ratio. Parity price of the bond equals $48 times 25 shares, which equals $1,200. The bond is currently trading at $1,150, or 115% of $1,000 par, and is convertible into $1,200 worth of stock. It certainly makes sense for the investor to convert at this point. Although you can try to make a point for choice C, it's not correct. On the Series 7 exam, if the stock is above parity, convert the bond. Convertible bonds and the underlying stock always seek parity. Even though $50 per share would be better than $48, the bond will also increase the price, and the conversion may not end up being as profitable. For the most part, investors would convert their bonds when the value of the convertible bond is trading at a price that is lower than the value of the stock is convertible into. This is known as arbitrage, taking advantage of a disparity in prices situation. Sometimes companies force a conversion, called a forced conversion, by calling bonds at a price that's less than parity. In this situation, converting is more advantageous for investors. Exploring U.S. government securities. On the Series 7 exam, you need to know the basic types of U.S. government securities, their initial maturities, and certain characteristics. As you may already know, the U.S. government also issues bonds. U.S. government bonds are considered the safest of all securities. Yes, you did read that correctly. The safest of all securities. I feel it's worth repeating. How can U.S. government securities be so safe when we're running such a large deficit? Guess what? I don't know. and you don't need to know either. I can only assume that the U.S. government can always print more currency to make payments on its securities if needed. However, even U.S. government securities are subject to certain risks, such as interest risk, reinvestment risk, purchasing power risk, and so forth. U.S. government securities are now all issued and held in electronic book entry form. However, because Treasury bonds have maturities of up to 30 years, some are still out there in paper form. U.S. government securities can be purchased directly through a website called Treasury Direct from broker-dealers and most commercial banks. With government bonds, you'll use some of the same calculations you use for corporate bonds. The methods for determining accrued interest, for example, are very similar. Understanding the types and characteristics of U.S. government securities. Security, interest maturity, and characteristics. Table 7-2, U.S. government securities and time until maturity. T-bills, Treasury bills. 4, 8, 13, 26, and 52 weeks. Issued at a discount and mature at par. The difference between the purchase price and par is considered interest even though not interest payments are made. Sold in investment increments of $100. T-notes. Treasury notes. 2, 3, 5, 7, and 10 years. Pay interest every 6 months. Sold in investment increments of $100. T-bonds. 20 or 30 years. And pay interest every 6 months. Sold on investment increments of $100. T-strips. Separate trading of registered interest and principal of securities. 6 months to 30 years. Issued at a discount at mature. At par, minimum investment is $100. They are not sold directly by the U.S. Treasury, but are sold by financial situations and government security broker-dealers. Investors do not receive interest payments. Purchase price varies. Tips. Treasury inflation protected securities. 5, 10, and 30 years. Pay interest every 6 months. Par value and interest payments adjust according to inflation or deflation. Sold in investment increments of $100. Tips are tied to the Consumer Price Index, which measures inflation. The par value changes according to inflation. If inflation is high, prices of goods and services are increasing. The par value increases. If we're in a period of deflation, prices on goods and services are decreasing. The par value decreases. Because investors are getting a percentage of par value as their interest payments, the interest payments are varying along with the par value. T-bills are sold on discount yield basis, where the bid is higher than the risk. Typically, you might see the bid and ask prices for bond as 99.5 to 99.7 respectively. This means that a person is bidding $995 or 99.9% times $1,000 par to purchase the bond, while another person is willing to sell the bond for $997. However, for T-bills, you might see the bid and ask price as 2.250 minus 2.150 respectively. The reason that they are quoted like this is that the bidder is bidding for a yield of 2.250, which would represent a lower dollar price than the ask price of 2.150. So if you see that the bid number higher, if you see the bid number higher than the ask number, it is likely a T-bill quote. For the Series 7, remember that the interest received on U.S. government securities is exempt from state and local taxes. The interest received on municipal bonds is federal from federal taxes. Although I get into that later on, and just listen up. The following example question concerns various types of bonds and U.S. government securities. One of your new customers calls to tell you that his wife just had a baby. He would like to start saving for the child's higher education. He has $30,000 to invest and seems genuinely concerned about the safety of his investment. Which of the following bonds would you most likely recommend to help him meet his goals? A. AA rated corporate bonds with 18 years until maturity, and B. T-strips with 18 years until maturity. C. T-bonds with 18 years until maturity, or D. High-yielding corporate bonds. The choice is B. The question gives you a couple clues. The investor is concerned about safety, so choice D is definitely out. High-yielding corporate bonds are low-rated bonds and are speculative. Out of the three choices, B makes the most sense. The customer were to invest $30,000 in the AA-rated corporate bonds or the T-bonds, he received $30,000 at maturity along with interest payments along the way. However, interest entails risk. T-strips, on the other hand, don't pay interest, so investors can purchase them at a discount. Because the bonds mature at 18 years, perhaps this investor can purchase the T-strips for around $40 each. He could buy 75 bonds with $1,000 par value, which would probably be worth $75,000 in 18 years. When you see a question on the Series 7 exam about the best investment when planning for a future event like college, the right answer will most likely be either zero coupon bonds or T-strips. Agency securities. Agency bonds are ones issued by a U.S. government-sponsored agency, or GSEs, government-sponsored entities. The bonds are backed by the U.S. government, and not all are guaranteed by the full faith and credit of the U.S. government, except a government national mortgage association, which are directly backed. As such, agency bonds, although almost as safe, are considered riskier than U.S. government bonds such as T-bonds, T-notes, T-bills, and so on. GSEs include Government National Mortgage Association, or Ginnie Mae, Ginnie Maes are the only agency securities backed by the full faith and credit of the U.S. government. Ginnie Maes support the Department of Housing and Urban Development, HUD. Like Treasury securities, the risk of default is almost non-existent. However, unlike Treasury securities, the interest earned on Ginnie Mae securities is taxed on all levels, federal, state, and local. They are often called Ginnie Mae pass-through certificates because the principal and interest payments pass through to investors. So to investors receive monthly payments of interest and principal as people pay their mortgages. Over the years, as investors pay down their mortgages, the principal amount will decrease. Ginnie Maes are issued with a face value of $25,000 but can be purchased in denominations as low as $1,000. As with other mortgage-backed securities, they are subject to prepayment and extension risk. Fannie Mae. Fannie Mae is publicly held corporation that is responsible for providing capital for certain mortgages. Federal National Mortgage Association. As such, Fannie Mae may purchase conventional mortgages, VA mortgages, FHA mortgages, and so on. Fannie Mae is privately owned and publicly held, but is still government sponsored. Fannie Mae issues debentures with maturity rates from 3 to 25 years and are issued at minimum denominations of $10,000. Longer-term bonds issued by Fannie Mae are pass-through certificates, meaning that the principal and interest are paid monthly. However, Fannie Mae also issues discount notes and benchmark bills, which are shorter-term debt securities available with minimum denominations of $1,000. Shorter-term debt securities are issued at a discount and mature at par, so they don't receive monthly payments. Like Ginnie Maes, they are taxed on all levels. However, unlike Ginnie Maes, they don't have the direct backing of the U.S. government, so the risk of default is a little higher. As you would expect, the Fannie Mae is a little riskier. Investors receive a higher return. Freddie Mac, or Federal Home Loan Mortgage Corporation. As a public corporation, Freddie Mac was designed to create a secondary market for mortgages. Freddie Mac purchases residential mortgages from municipal institutions and packages them into mortgage-backed securities, which are sold to investors. Freddie Mac also issues pass-through certificates, and the interest is subject to federal, state, and local taxes. Like Fannie Mae Securities, Freddie Mac is not directly backed by the U.S. government. FCS, Farm Credit System. The FCS consists of lending institutions which provide financing and credit to farmers. It is a government-sponsored agency that is privately owned. The FCS sells securities to investors and turns loans, and in turn, loans the funds raised to farmers. The FCS is overseen by the FCA, the Federal Credit Administration, the Farm Credit Administration. FCS issues discount notes and bonds ranging in maturity from 1 day to 30 years. Unlike Ginnie Mae, Fannie Mae, and Freddie Mac securities, the interest received from FCS securities is exempt from state and local taxes, but is still subject to federal taxes. SLMA, Student Loan Marketing Association. Student Loan Marketing Association, or SLMA, is not involved in providing mortgages, but provides a secondary market for student loans. As such, SLMA purchases student loans and repackages them as short and medium-term debt securities for sale to investors. Sallie Mac is no longer a government-sponsored enterprise, but is now a private company. So SLMA also issues stock, which is currently trading on NASDAQ. Interest earned on its debt securities is subject to federal tax, but may be exempt from state and local taxes depending on the state. Certain mortgage-backed securities have an average life, which is shorter than an initial term loan. This is due to investors selling or refinancing their houses. For argument's sake, let's say that the average homeowner purchases a 30-year mortgage. However, due to interest rate drop, he may decide to refinance after 14 years. Therefore, the securities are susceptible to investment risk because many homeowners refinance when investor rates fall. Prepayment risk. In that case, holders of mortgage-backed securities would get paid back sooner than expected and would have to invest at a lower interest rate. In addition, if interest rates stay the same or increase, homeowners will not refinance as often, and the holders of mortgage-backed securities may end up having to hold their investment for a longer period of time than expected. Extension risk. In the trenches, delving into package mortgages, CMOs. Just when you thought you were going to get out of debt securities relatively unscathed, you have collateralized mortgage obligations, CMOs, thrown at you. CMOs are annoying little or big debt securities backed by pools of mortgages. Ginnie Mae, Fannie Mae, Freddie Mac. What makes matters worse is that you probably won't sell one in your entire career. However, CMOs are asset-backed securities covered on the Series 7 exam, and you need to know the basics in order to answer those questions correctly. CMOs don't have a set maturity date and are subject to things called extension risk and prepayment risk. Listen to these terms. Average life. The average amount of time until a mortgage is refinanced or paid off. For example, a 30-year mortgage may have an average life of 17 years. Prepayment risk, the risk that a tranche, a slice or portion of the loan will be called sooner than expected due to decreasing interest rates. More people refinance when interest rates are low. Extension risk, the risk that a tranche will be called later than expected due to a less than normal amount of refinancing. Extension occurs when interest rates are high. CMOs are broken down into tranches, slices of varying maturity dates. The basic types of CMOs have tranches that are paid in a specific sequence. All tranches receive regular interest payments, but only the tranche with the shortest maturity receives principal payments. After the shortest tranche is retired, the second shortest receives principal payments until the tranche is retired, and then the principal is paid to the next tranche. This type of structure is known as plain vanilla offering. The following list describes other types of CMO tranches. Planned amortization class tranches, PAC tranches. This type of CMO is the most common because it has the most certain prepayment date. The prepayment and extension risk can be somewhat negated by a companion tranche, which assumes a greater risk of the greater degree of the risk. Because of the relative safety of PAC tranches, they usually have the lowest yields. Targeted amortization class tranches. This CMO is the second fastest. TAC tranche holders have somewhat less certain principal payments and are more subject to prepayment and extension risk. TAC tranches have yields that are low but not as low as those of PAC tranches. Companion tranches, support bonds. Companion tranches are included in every CMO that has PAC or TAC tranches. Companion tranches absorb prepayment risk associated with CMOs. The average life of companion tranche varies greatly depending on interest rate fluctuations because more risk is associated with companion tranches. They have higher risk, higher yields. Z tranches, accrued bonds. Z tranches are usually the last tranche. They have the longest maturity in a series of PAC or companion tranches. The Z tranches don't receive interest or principal until all of the other tranches in the series have been retired. The market value of Z tranches can fluctuate widely. Z tranches are somewhat similar to a zero coupon bond, which is bought at a discount and does not receive interest along the way. Principal only tranches, PO. Principal only tranches are purchased at a price deeply discounted below face value. Investors receive face value through regularly scheduled mortgage payments and prepayments. The market value of PO increases if interest rates drop and prepayments increase. Interest-only tranches, IO. If CMOs with principal-only tranches also have interest-only tranches, IOs are sold at a deep discount below their expected value based on the principal amount used to calculate the amount of interest due. Contrary to PO tranches, the market value of IO increases if interest rates increase and prepayments decrease. Floating rate tranches. The tranches appear with CMOs in which the interest rates are tied to interest rate index. For example, London Interbank Offered Rate, LIBOR. Investors can use these investments to hedge interest rate risk on other investments. Although I discussed several types of tranches, the most important ones on the Series 7 exam are the PAC, TAC, Companion, and Z tranches. The following question tests your understanding of tranches. Companion tranches support. 1. PO tranches. 2. PAC tranches. 3. TAC tranches. 4. IO tranches. A. 1 only. B. 2 only. C. 2 and 3 only. D. 2, 3, and 4. The answer you're looking for is choice C. Companion tranches absorb the prepayment risk associated with CMOs. All PACs and TAC tranches are supported by companion tranche. I know that this information is a lot to take in and may be a little confusing. Remember the basics, and it can help you get the most out of most of the questions correct. PAC tranches are the safest. TAC tranches are the second safest. Companion tranches support PAC and TAC tranches, and Z tranches have the longest maturity. CMO communications. Retail communications regarding CMOs must include the words collateralized mortgage obligation. Must not compare CMOs to other investment vehicles. Must include that the government agencies backing the CMO are only responsible for face value of the CMO and not any premium paid. and must disclose that the CMO's yield and average life will fluctuate depending on changing interest rates and the rate at which homeowners refinance their loans. Prior to the sale of a CMO to any investor other than an institutional investor, a member must offer the investor educational material about CMOs. The required educational material must include these items: the characteristics and risk of investing in CMOs, credit quality, prepayment rates, average lives, how interest rates affect prepayment rates, tax considerations, liquidity, minimum investments, and transaction costs. In addition, the educational material must include how CMOs are structured, the different types of tranches and their risk, and the relationship between mortgage securities and mortgage loans. Also included in the educational material should be questions an investor should ask before investing, and a glossary of terms. If a member is promoting a specific CMO, any communications must include the following: the coupon rate, the specific tranche, number and class, the anticipated yield, the anticipated average life, the final maturity date, and the underlying collateral. In addition, it must include a disclosure statement saying the yield and average life shown above consider prepayment assumptions that may or may not be met. Changes in payments may significantly affect yield and average life. Please contact your representative for more information on CMOs and how they react to different market conditions. Remember that retail communication mailed out by any member or member firm must include the firm's name, membership's address, telephone number, and representative's name. Radio and television advertisements must include the following statements. The following is an advertisement for collateralized mortgage obligations. Contact your representative for information on CMOs and how they react to different market conditions. The yield and average life reflect prepayment assumptions that may or may not be met. Changes in payments may significantly affect yield and average life. Backed by debt. Collateralized debt obligations, CDOs. Now that you're a master of CMOs, I figure this is the point at which it makes the most sense to go into collateralized debt securities, CDOs. The idea behind CDOs is quite similar to collateralized mortgage obligations because they're also broken down into tranches representing different amounts of risk and or maturities. Obviously, as with other investments, the more risk, the more reward or potential reward. The difference with CDOs is that instead of being backed by mortgages, they're backed by pools of bonds, loans, or other debt instruments. In the event of a shortfall of cash, holders of senior CDOs are paid first. I can break them down into classes for you, but fortunately, I think that would be more than you need to know for the Series 7 exam. Interest received from CDOs is taxable on all levels, federal, state, and local. CDOs are not ideal investments for most investors. CDOs are complex or often difficult for average investors to understand. Therefore, they are more suitable for sophisticated or institutional investors. Plain and safe, short-term loans or money market instruments. Every Series 7 exam includes a few questions on money market instruments. Money market instruments are relatively safe short-term loans that can be issued by corporations, banks, the U.S. government, and municipalities. Most have maturities of 1 year or less, and they're issued at a discount and mature at par value. The following list reviews some basic characteristics of money market instruments to help you earn an easy point or two on the Series 7 exam. Federal funds. Federal funds are loans between banks to help meet reserve requirements. Federal funds are usually overnight loans for which the rates change constantly depending on supply and demand. Remember, reserve requirements are the percentage of deposits that a member banks must hold each night. Banks that aren't able to meet the reserve requirements may borrow from other banks at the Fed funds rate. Corporate commercial paper. Corporate commercial paper is unsecured corporate debt. Commercial paper is issued at a discount and matures at par value. Commercial paper is issued at an initial maturity of 270 days or less and is exempt from SEC regulation. Broker negotiable certificates of deposit. Broker CDs are low-risk investments which originate from a bank and are outsourced to broker-dealers to sell to investors. Unlike typical CDs, which are purchased directly from a bank, broker CDs can be traded in the market. Negotiable certificates of deposit that require a minimum investment of $100,000 are often called jumbo CDs. Eurodollars. Eurodollars are American dollars held by a foreign bank outside the U.S. This situation is usually the result of payments made to overseas companies. Eurodollars are not to be confused with Eurodollar bonds or dollar-denominated bonds issued and held overseas. Bankers' acceptances. A banker's acceptance, BA, is a time draft, short-term credit investment created by a company whose payment is guaranteed by a bank. Company use BAs for the importing and exporting of goods. T-bills. The U.S. government issues T-bills at a discount, and they have initial maturities of 4, 8, 13, 26, or 52 weeks. T-bills are somewhat unique in that they're sold and quoted on a discount yield basis, YTM. U.S. government securities, and especially T-bills, are considered the safest of all investments. Here's what a question on money market instruments may sound like. SNK Surfboard Company wants to import boogie boards from an Italian manufacturer in Sicily. SNK would use which of the following money market instruments to finance the importing of boogie boards? A. T-bills. B. Collateral trust bonds. C. Repurchase agreements. D. Bankers' acceptances. The correct answer is choice D. You can eliminate choice B right away because collateral trust bonds aren't money market instruments because they're secured long-term bonds. A banker's acceptance is like a post-dated check that's used specifically for importing and exporting goods. Word association can help you here. If you see importing and exporting or time draft, your answer is probably banker's acceptance, BA. Structured products. Structured products are relatively new and have somewhat of a broad definition. However, putting something complex in simple terms, structured products are prepackaged products put together by some other entity, bank, brokerage firm, and so on. Structured products are based on derivatives such as options, which means that the investors don't own the underlying securities directly but have an interest in their performance. The structured product could be based off the performance of an equity index, foreign currencies, a basket of securities, a single security, and so on. Structured products typically require minimum investment and are fixed term, such as 12 months, 18 months, 2 years, 3 years, 5 years, etc. Most structured products are a combination of a note, a short-term debt security, and a derivative product. Unless the note is zero coupon, investors will receive interest payments, and the return at maturity will typically be the face value of the note plus a premium if the derivative portion performs well. Exchange traded notes. ETNs, exchange traded notes, have characteristics of exchange traded funds and fixed income securities. ETNs are unsecured debt securities issued by a bank or financial institution. Their return is usually linked to a particular net market index or, in some cases, commodities or currency. Exchange traded notes don't receive dividend or coupon payments, so investors receive income at a specified maturity date. Since they are traded on an exchange such as the New York Stock Exchange, they may be purchased on margin or sold short. Investors may trade the ETNs or hold them until maturity. If an investor holds the ETN until maturity date, the investor will receive a principal payment less any fees based on performance of the index the note is tracking. Note, even though the returns on ETNs are usually linked to returns on a particular market index, an ETN's value may drop due to a drop in the credit rating of the ETN issuer even if the index decrease. Mutual funds represent ownership in a pool of securities. ETNs do not, as they simply track the performance of a specified market index. ETNs are typically issued by banks and other financial institutions. Equity-linked notes. Unlike exchange-traded notes, equity-linked notes are not traded on an exchange. Equity-linked notes are most often created as bonds. However, instead of having fixed interest payments, the interest payments are variable depending on the return of the underlying market securities, equity securities. The return on equity-linked notes may be based off the return of a single stock, the basket of stocks, or an equity index, sometimes referred to as index-linked notes. Structured products are more complex in nature and often require investors to tie money up for a period of several years. Therefore, they are not considered suitable investments for most people.